Good morning, everybody, and welcome to the Hardcore Mortgage Real Estate Business Podcast. Today is Wednesday, March 2nd, 2022. The podcast is brought to you by Capital Mortgage Funding, powered by Fairway Independent Mortgage Corporation, Equal Housing Lender, 2289 our NMLS number. And keeping with the theme of last night, the State of the Union address was last night, March 1st, 2022. The State of the Mortgage Industry address by me, with commentary from either like parties or opposite parties, is always welcome. Today on the podcast, I have Miss Becky Alley. Hi, Becky.
Hey, everybody.
Mr. John Kolb. Hi, John.
Hey, guys. How's it going?
It was a bad loss last night, John. I was at the game. It was horrible. It was the worst.
Who played?
Anyways, I hope our State of the Union is in better shape than Michigan State basketball. And we also have Mr. Harvey Freed. Hey, Harv.
Good morning, everybody.
How's it going today?
Going great.
Good. As always, producing and directing, we have Roberto Beauchene in the booth. Hi, Roberto. You can't hear me, but hi, Roberto. How's it going? All right, good. Topic number one, State of the Mortgage Industry address for March 2nd, 2022, and for the foreseeable future. Housing inventory will get absolutely no relief April, May, June, July, August, and September of 2022. Let me give you the reason why. And that's not a bad thing, everybody. That is a good thing, actually, because that means that there are a lot of buyers in the market. Home inventory, housing inventory is not going to increase dramatically, but it is increasing. Home prices are not done setting records. Now, some people would say, well, that's a bad thing. It's not a bad thing. You want to continue to see homes increase in price. And in the middle of my address, I'm getting a phone call, which is not good. So, State of the Union, housing inventory for the foreseeable future, it will not get any better, marketably better. Yeah, will a few more listings come on the market? Of course. But again, as I reiterate, this is not a bad thing. Home prices, home appreciation will continue to go up. Now I turn to my colleagues, Becky Alley.
Yes, I agree with everything you're saying. I don't think that we're going to see any relief because anything that comes onto the market is going to be quickly gobbled up by the surge of buyers that are constantly infiltrating the market, right? So it's a beautiful thing. People are excited to buy homes. But I do, like we've talked about before, I have empathy for buyers entering because not only are they dealing with the surge in the market with the prices going up, but then we also have the interest rate adjustments that are affecting people's payments, in some cases by $200 more than they were 60 days ago. But either way, we're on top of it. This is what we do for a living. So we're circling back, making sure that everyone maintains that approval, right? But the biggest thing is that with the markets surging, you made a point about how, people are saying it's a bad thing. It's a bad thing when the lenders are assuming the risk if the market is going up right now. But right now, the property values surging is because the consumer is driving up that price by those additional cash that they're throwing into the market. So this isn't a surge in market based off of artificially inflated prices. This is a surge in market based off of the buyers assuming that risk, because ultimately the lender, i.e. us, we're only going to lend based off the appraised value. So then if the buyer in turn is saying, okay, well, I'm going to pay $10,000 above that asking price and above what the house appraised for, well, then now that becomes a comp, and that is now going to set a baseline for future sales. So that's kind of what we're dealing with, and I don't really see that changing anytime soon. So I do agree with you there.
Great. John Kolb, housing inventory for the foreseeable future. Do you have a like take or do you have an opposite viewpoint? My belief is we will not have any relief for the next 6 months.
Yeah, I mean, I agree with you. I don't think there is going to be any relief. The hope that is that people, deal with some good real estate agents that know how to manipulate a contract so that if you do put your house on the market, you have time to go out there and take a look at other homes. Maybe prolong the closing, ask for some rent backs, something that would allow, people, because there are a ton. I met with about 3 or 4 different people last week, all first-time home buyers, and they all have concessions to give. They have places to stay while they're shopping for a home. So what better way, if I were to sell my house without a house to move into, put a close out 60, 90 days out, and then ask for 30, 60 days of that I could rent the place back to them, so that it gives me anywhere from 4 to 6 months to go out there and take a look and find my other home, my dream home. In the event that I don't find that dream home in the first 60, 90 days before we've closed, maybe at that point I can cancel the transaction, put something else in writing. But at least it'll get more people out there, more houses on the market. And the hope would be to just add some inventory so that we can get some stuff spurring. But yeah, it's busy. I'm not gonna complain about that. We've got people out there looking. We've got people out, whether they have houses or not, they're out there looking.
Yep, great. And Harvey, your take on it. It is busy out there. People out there, they want to buy houses, but state of the mortgage industry right this second, housing inventory for the foreseeable future, my opinion, in 6 months, it's not even opinion anymore. It's a fact. We are not going to see a marketable change or any relief within the next 6 months. Harvey Freed.
I agree with our panel 100%. Nothing's going to change. We've been talking about it again. The Hardcore Mortgage Show gives you the straight shot information every Saturday morning. So nothing's going to change. They're not going to miraculously build some ranches overnight, starting at 1,000 square feet to 2,800 square feet. With that being said, as John mentioned, several competing offers on even the starter homes, anything between 100 and 300,000. It's even the investors on those houses. So never more important to have, forget about this pre-approval stuff. We do real approvals here. That way you can close in 30 days. Really, a lot of the first-time home buyers have been calling us. They are not prepared. Some of them really do want the help. It's nice to see. It's refreshing to see. I got a young buyer, 22 years old, reached out to us yesterday, heard good things about us, and now we're going to sit down and really put a nice plan together. So MSHDA loans, again, your FHA loans, those are harder to compete with a conventional offer, and you still got to compete against potentially some cash offers. So, what the panel said, it's going to be tough to buy a house this year.
All right, excellent. Point number 2 in the State of the Mortgage Industry address today, March 2nd, 2022, piggybacking on the State of the Union address. I believe the future for home buying is still very, very strong. As a matter of fact, right now, everybody, as we touched upon, and I'm going to get into a little bit more depth right now, home prices are not done setting records yet. 2021, to recap, nationally, 19.1% increase in home prices over the previous year. Projected this year, reality, 2022, the annual pace is going to remain in the double digits. That would mean above 10%, at least minimum. I'm saying for the entire year, at least minimum for the next 6 months. So again, home prices for the foreseeable future will continue to rise. And I say that's a good thing. Why is it a good thing? Again, to recap, because you always want to see home values and prices go up. I know that sounds contrarian, but if you bought a house in 2021, you don't want to see it go under what you bought it for in 21. You want to see it go up. So home prices, Becky Alley and panel, Becky first, will remain high, and they will continue to go up throughout 2022.
Yeah, I mean, it's no secret. We are, buyers are driving the home prices up, right? As long as there's a lack of inventory and you have 30 people fighting over one house, someone wants it bad enough where they're going to pay whatever it takes, right? If someone wants something bad enough, they're going to pay for it, right? And then that is going to become a comp. And now my house, in turn, is going to be worth more. So if I'm planning on staying and I want to do renovations, that puts me in a position where I'm able to tap into instant equity or get rid of PMI. I mean, so it is a good thing across the board. Again, it's frustrating for buyers. So like I said, I'm empathetic to that because they are going against, they're really getting put through the ringer, cash offers, investors, second home buyers. So if you're a first timer coming in the market, we're here to help you. We're going to find ways to make it competitive. But yes, there is nothing bad about something that you own appreciating in value, right? It's not a home. You don't want it to be a car where as soon as you drive it off the lot, it's down 20%. It's, this is a tangible asset, and 90% of the time it's most of yours, our listeners, our viewers, our diehard fans. It is your biggest investment, right? So you never want something like that to depreciate. I don't think it's going to be some time till we see some depreciation, but if anything, it's just going to be when it does happen, if and when, it's really just going to be just kind of just a calming based off of inventory, but it's not going to be a matter of now your house isn't worth $1 million, right? So I think it's good things, and it's definitely not going to be changing this year.
Yep, all very strong points, Becky Alley. Very solid presentation. This is a Hardcore Mortgage Real Estate and Business Podcast brought to you by Capital Mortgage Funding, powered by Fairway Independent Mortgage Corporation, equal housing lender, NMLS number 2289. John Kolb, home prices for the foreseeable future are going to continue to go up. We give it hardcore answers to your hardcore questions. We're addressing this head on because, John, too many times people pussyfoot around the issues. They mealy mouth them. We don't do that. John Kolb, home prices for the foreseeable future are going to continue to rise. We're not going to see a decline in prices. Matter of fact, my opinion is home prices are not done going up for 2022.
Yeah, I mean, let the haters start. Because I know we're gonna talk about this on Saturday on the radio show. Let the haters start. We'll get the ticket text because they'll be hiding behind their phones, stating that this is a bubble and these guys are just talking about things that are gonna implode on them. And no, it's not. It's here to stay. Fannie Mae, Freddie Mac, they didn't increase the minimum loan size for jumbo and conventional to 647-200 just out of willy-nilly. They know that prices are going up. They want loan amounts to go up. They know they want people to still be able to meet the guidelines that Fannie and Freddie have set forth. So that's why they have increased the loan size to from 480 something to 647-200 for this year. So yeah, I mean, they're going to stay. All the facts are there. And you're going to get the people that want to just argue, debate, and yell, Harvey Freed, about certain things, but we'll be here to counteract it.
Excellent points, John. We appreciate that. And again, we're not afraid of that little confrontation that people want to argue facts with us. My saying, everybody's entitled to their own opinion, but they're not entitled to their own facts. And the facts are that things are going up. The facts are that, as we state, Harvey Freed, I want you to bring some facts. Home prices for the foreseeable future, Harvey Freed, 2022, they're not going to go down. They're going to go up. And I don't think that's a bad thing. What do you think?
The Mortgage Bankers of America have it somewhere around 7.4%. The most rambunctious quotes were maybe 14 to 17% appreciation. I don't know, somewhere between 7 and 10%. It's really on the high side. Makes real estate a great investment, a good diversification for your portfolio. So yeah, it's just sort of irrelevant. You need a roof over your head. You get to live on this side of the grass for one time only, as far as I know. And if you pick a home that you're going to enjoy your life in, and again, make sure it checks at least most of the boxes in today's competitive market.
I mean, to that point though, too, I wanted to just touch real quick. I mean, what John was saying, people like talking about there's a bubble and all that stuff. Again, like we mentioned, lenders are not ensuing the risk. These are well-qualified mortgages. This isn't where people are qualifying for homes that they can't afford. I mean, the underwriting guidelines are progressive. Yes, everyone's looking to get people into homes, but again, these are well-qualified mortgages, and these are not artificially inflated prices. These are prices that the home came in at $220, and the buyer decided that they're going to pay $230 for it, and they coughed up an extra $10,000. This isn't something that a lender or an appraiser dictated. The buyers are dictating this market. So it's a totally different situation from any other kind of bubble that we experienced, 12 years ago.
Well, Becky, that's a great point also. And to piggyback off that, and before I move into my third point about interest rates for the foreseeable future, I'm going to go ahead and tell you this. And in 2006, 7, 8, and 9, the interest rates on a 30-year fix were not between 2.5% and 4%. So everybody that bought a house and they're predicting a bubble and a crash, they're not going to walk away from a house that has an interest rate of between 2.5% and 4%. It's just not going to happen that way. So if
Right.
people want to go back into history and say, be careful, look what happened before, you're not going to find a perfect storm of a terrible economy, job loss, and interest rates that are way higher than they are now. And like you said, the mortgages people are qualifying for now, they're putting down more money. There are no subprime mortgages in play. There are no 125 LTV loans. For all you mortgage nerds out there, that means people were lending 25% above the value of a house. How does that even make sense? It doesn't. Not happening now. So, Becky, I couldn't agree with you and John more. Third point, Becky Alley, interest rates for the foreseeable future are going to be higher. I'm going to define higher. Higher than 2020, higher than 2022 or 21. In 2022, the interest range rate, did I say that properly? That's like that's like headset fast food phone jockey. Is it headset fast food phone jockey or is it headset phone jockey fast food guy? I don't know. But all I know is this, is that interest rates for the foreseeable future are going to range anywhere on a 30-year fixed between 3.75 and 5%. You're going to say, Harry, well, that's a pretty safe range. Yeah, that's what the range is going to be. That's why you call it a range. And furthermore, they're going to be higher than 2020 and 21. Don't go back and think that you could get a rate at the same rate somebody got in 2020 and 21. All right. What kind of impact will that have? It impacts the buying power of a first-time home buyer, of a trade-up buyer, and a scaled-down buyer. Okay. But the bottom line is that they're still historically low. If you look throughout history, the last 60 years, if you could say that you're going to get an interest rate between 3.75 and 5%, the answer from everybody should be, Becky Alley, I'll take it historically.
Yes. The thing is that they predicted rates to be, the range that you were talking about, through the fourth quarter of 2022, right? We're already there, right? And we touched on this before. It's because just like the stock market, rates are forward looking, right? As soon as you start flirting about the Fed adjusting things, the rates started getting in position already with that anticipation that's literally knocking on the door. They were talking about it again today, right? I do think that we're going to see a little bit of a pullback, but are we going to see a pullback to 2%? No, we're not. It's just the rates are just where they are. And historically, the rates in 2016 to 2018, in 2018, a 30-year fix was 4.875. And guess what? People are still buying houses, and it still made sense to refinance based off certain situations. Same with a 15-year fix. I mean, I feel like we're going to mirror that kind of market. 2018, I feel like the rates are going to kind of stay within that range. But again, you never know. I mean, things can happen and they could adjust down, but do I think we're going to see pandemic rates? No, that was a once in a lifetime thing that, just was a silver lining in a bad situation. And a lot of people were able to take advantage of it. But, and I know my colleagues will agree with me, but this is going to affect buying power. So we are going back and we are reevaluating our buyers that were pre-approved in December, that haven't found their homes yet, because they are looking at payments that could be up to $200 more, which now that's going to pull back their price if we were maxing it out based off of a lower rate.
Excellent. John Kolb, interest rates for the foreseeable future are going to be higher. And will we see a little relief? I'm not banking on that. If we get a little relief, that'll be great, but going higher. Thoughts?
I mean, this is a clear Harryism where he's, saying that rates are going to be higher, but he's happy if they go lower. This is how he gambles, with our little dollar bets on everything. He wins both ways. So, hey, you're right, Becky. Rates are already there. And do I think they're going to go higher? They're going to tick up a little bit. And then depending upon what's going on with all the issues overseas, unfortunately with world pricey. It causes our rates to come down a little bit. And if depending upon what goes on overseas, you might see a little bit of reprieve with our rates because the stock market might get a little jumpy. So I agree. I think rates are there. I don't see them getting too much higher. And they may trickle back a little bit, especially if the Fed does exactly what they said they were going to do, because we've already built so much in. In fact, we've built more in than we needed to. So I think you might see the rates come back a little bit as well. So I agree with Becky.
Excellent.
Circle
Mr.
gets the
Harvey
square.
Freed, thought process?
Yeah, all the same, you guys. Again, we say the same things because they're true. They're factual and they can't be changed in today's marketplace. The volatility of geopolitical events, as they say so elegantly on TV, are going to affect today's marketplace. Yesterday, I spoke to a client yesterday and he said, "Hey, Harvey, my brother said that rates got better today," and he was right. And then today the pricing changed again. Again, the rate might not get better, but the price might get better. So 3, 4, 5%. These rates are 3, 4, 5%. It doesn't matter if it's 1960, 80, or 2022. The cost to get that interest rate is what the client needs to learn about. We try to educate here. We want to educate you. So if you're listening to the podcast, send your client, your family to us to get a mortgage. We love giving you the knowledge. We love sharing the knowledge with you so you can make some great decisions. I've got a client here who's considering paying a discount point. It's a long-term play. He's buying a rental home, a very nice one that's going to generate a lot of income. He's convinced he's going to hold the mortgage. He's also convinced that interest rates today are still very, very good. And he's willing to pay a discount point. We did the math, and we also talk about the math. 26 months for him to break even. So if this mortgage that we do, if he keeps it for at least 26 months, he's going to start really saving money each and every month. And that helps his rental property as income. So the ROI. So very important that you understand and work with real professionals that can show you some interesting numbers.
Panel, I'm appreciative of all three of you. Right now, what the recap should be for everybody, and I'm going to go to your last words, Becky, John, and Harvey. But what I'm taking out of this entire thing in the state of the mortgage industry is that right now, more than ever before, because people were used to what they were used to before, extremely low interest rates, a plethora of homes on the market, maybe 3, 4, 5, 6 years ago. The last couple of years didn't happen that way. More and more, it's becoming more apparent that people need an experienced team on their side to win that transaction. You need a pre-approval that's going to hold water. You're going to need a realtor partner that knows the area, knows how to get deals done. And you need a lender that can come through with you, that underwrites their own loans, that funds their own loans, that does everything in-house so they don't have to ask a third party for permission to do anything, and that you can close. You don't need a quick closing because sellers aren't going anywhere. What you need is if you need a quick closing, that's fine. But it used to be we got to close in 2 weeks. We got to close in 3 weeks. That's just not the case because the seller isn't going anywhere. Becky Alley, how important, more than ever before, been doing this 32 years. Right now, experience matters.
Yeah, it's definitely going to be, it's been like that, but I feel like the market, sometimes consumers, you get a little bit, you want to go on the internet, right? And you find handshake mortgage that's out of the back of a van. I don't know where these people are from, but anyway, those people that are giving out those kind of pre-approvals in this kind of market, a listing agent is going to more than likely go with the lender that they know and that they're familiar with, because it's important that transactions close in a timely manner. Can we close a transaction in 11 days? Yes. But to Harry's point, they're not ready. So we're sitting in a clear to close status, waiting for the sellers to get ready, because like John mentioned earlier in our podcast, that the sellers still need to find their own place, right? So we can adapt and we can adjust, and hopefully you're working with a professional that can do that, even if it's not capital mortgage funding. But yes, the Googling of the online lenders, it needs to, it is what it is, but more so than ever, you need to be with someone that knows how to find a problem, identify the problem, and squash a problem before you even know it's a problem, versus just kind of, someone giving you a teaser rate online, and then you find out you're paying $5,000 for a rate you had no idea, right? So there's a lot of that happening. I looked at one yesterday, literally going up against, I don't even know what the mortgage company was called. And the MLS number was like 20 million, just got licensed yesterday. Be that as it may, you got to start somewhere. However, our client had no idea the amount of cost that they were paying. So once I looked at it and I pointed it out, I said, I can do that too, but does it make sense? Did you think about that? And we broke it down and we made that decision, and, we're moving forward, and, all is well. But, it's something that you need to make sure that you're surrounding yourself with people that are looking out for you. And at the end of the day, if it's not Capital Mortgage Funding, we're going to shake your hand, but we're also going to be a sounding board for you to point you in the right direction, whether it's us or not, because we care about ourselves, our livelihoods, and this industry as a whole.
Thank you, Becky. John Kolb, last words for the State of the Mortgage Industry address today, March 2nd, 2022.
I got an interesting email the other day from a client just saying, that he was advised to start shopping lenders, and what did I think about that? And he, not that he was looking to steer away from us, but what did I think about that? And I put a phone call together with him and just clearly said, I have no problem with you shopping around to different lenders. Just make sure that you're, comparing apples and apples. I'm very confident in how myself and my company and my team does our business. We make sure that we handle everybody with care, love, treat everybody like we would want to be treated. And then did explain that, you're going to get a lot of people that go through and just, get you the quick, easy, fast numbers just to get you in the door, get that $500 application fee. And then next thing you know, you don't know what's going on, and things change a million times between now and closing. So I think I was very confident with him. And I said, and I didn't try to tell him to not shop around. That's everyone's right. I want people to go through and see how much better we are than everybody else out there. So that being said, like Becky said, you got to make sure you're dealing with a reputable lender. Make sure that you have the relationship that's going to be there, and get out there and start looking for homes.
Excellent, John. Great recap. Harvey, what is your recap? Your last words, state of the mortgage industry, March 2nd, 2022.
We touched on it a little bit. Experts in the industry are who you need. I've seen many pre-approval letters saying conventional mortgage. The clients have back-end ratios over 50%. They start new jobs. They are using overtime and commission income in the first 6 months. It's not allowed. The clients are calling us at the last minute saying this other lender on TV and on radio who advertises a lot told us we were good. It's not true. They're calling people back and they're lying out there, and it's scary. Again, it's supposed to be a fun experience. Deal with real professionals, deal with the experienced professionals. And if you're going to make one call to a mortgage company, call us. If you're going to make 2 calls, make sure we're one of them.
Excellent, Harvey. That was Harvey Freed, host of the most hardcore mortgage real estate business show, heard every Saturday morning, 97.1 FM from 9 to 10. He frequently has Becky Alley co-host, John Kolb co-host, Lisa Lawson will always join us. I occasionally pop in, just sit in there and make sure we're all compliant and legal and everything. Everybody, this was the State of the Mortgage Industry address, March 2nd, 2022. To recap for everybody, housing inventory for the foreseeable future will be down. Home prices for the foreseeable future will continue to go up, and mortgage interest rates will continue to be between 3.75 and 5% on a 30-year fix, probably throughout 2022, and they will not, I repeat, not go down to 2020, 21 levels. I first made that proclamation on January 19th. Okay, so what was that? 6-8 weeks ago? Yeah, that's right. I made the proclamation. I don't like it, but it is what it is, because everybody, we give you the hardcore facts. This has been the Hardcore Mortgage Real Estate Business Podcast, March 2nd, 2022, State of the Union Address. Thank you very much.